Hello everyone, my name is Kristen Schulson. I'm sitting here today with Lou Kokernak, the principal for Haven Financial Advisors, and we're here today to talk about the Chinese stock market. I'll start off today by asking you, why is it important to talk about the Chinese stock market?
There's a couple of key things that are going on right now, Kristen, I think make it very important for investors. First of all, China is the world's second largest economy. It's going to surpass the United States in the year 2029 or 2030, something along those lines. And its own stock market, while typically not followed closely in the U.S., has risen to very substantial proportions. It's about a $10.8 trillion marketplace right now. That's larger than the European Union. So it's very significant. And more recently, some of the major index providers worldwide are starting to recognize the importance of Chinese stocks and are starting to migrate them into some of the major emerging market stock indices.
And Lou, what do you feel that investors should know about the Chinese companies today?
Well, there's a few things. We've talked very positively about the evolution of the Chinese stock market thus far, Kristen, but there are some cautionary notes. The Chinese government takes a very strong and intrusive view into the operation of the Chinese stock market. They've created basically a surveillance state in the last few years to monitor the trading activities of virtually every actor in their financial system. In 2015, China had a very significant stock market sell-off, and the Chinese government sprung into action. They threatened journalists that wrote negative stories about Chinese companies. They suspended the trading of roughly half the stocks on the Shenzhen and Shanghai stock market. They suspended IPOs. They levied sanctions against actors that sold large blocks of stock. In effect, the Chinese government became a big cheerleader for the stock market. They were a cheerleader with a sledgehammer. And that's not the type of thing that Western investors are comfortable with. And that's one of the reasons I think that the major index providers are dipping their toe in the Chinese stock market rather than just jumping in wholeheartedly, because it's not a freely trading stock market like we're familiar with in the Western economies.
Can you tell us a little bit about the history of the modern Chinese stock market?
The Chinese stock market has traded regularly since the early 1990s. In the last 25 years, the Chinese economy has grown immensely, and along with that, its stock markets have expanded in a commensurate way. The Chinese stock market is structured differently than the United States and other Western economies. It's more closed, it's more highly regulated, and the overall structure of the Chinese economy is a little bit different. Whereas the United States and Western economies rely substantially on stock financing, China's companies rely a lot on bank loans and debt. So all else being equal, a Chinese company is not going to have the same level of stock issuance as a comparably sized American company.
And tell us about what's going on with China's representation in the major stock indices.
There's been a lot going on in the emerging market stock industry with respect to Chinese representation. In 2015, FTSE, a major index provider, started phasing in Chinese A-shares in their emerging market index. They pledged to continue to increase China's weighting as China in turn lifts their quotas on foreign investment on the A-share marketplace. Also, MSCI, again another index provider, on June 1st of this year added 233 Chinese A-shares to their own emerging market stock index. So what we're seeing here is a gradual increase in China's weighting in major stock market indices. Right now, depending on which ETF you buy, emerging market ETF, you're going to probably have about a 30% weighting in Chinese companies. If China's free float, that is the freely traded stock market, is fully represented in these stock market indices, that ratio is going to go up to about 50%. So that's a pretty big change.
And finally, Lou, can you tell me a little bit about your view on the long term?
Yeah, the long term, Kristen, despite the drawbacks and the intrusiveness of the Chinese government, I'm bullish on the Chinese stock market. They have grown, or the stock market has grown from almost nothing in 1990 to a nearly $11 trillion marketplace today. That's astounding. And ultimately, investors follow where the money is. And China is the world's fastest growing major economy. Its stock market, despite the fits and starts in terms of it being opened up to Western investors, is in the long run, moving towards more openness. So the combination of the economic growth and the gradually increasing Western access to Chinese stock markets, I think is going to make it a very significant player. And I think within a few years, probably not tomorrow or next week, we're going to be as interested in the results of the Shanghai and Shenzhen stock exchanges as we are in the New York Stock Exchange.
Thank you. Thank you so much, everyone, for joining us today. If you have any questions about the Chinese stock market, please reach out to Lou Kokernak at the email listed below. Thank you.